My buddy Jake called me the night before his closing date. He was freaking out. His lender had just told him he needed to bring $13,800 to the closing table the next morning. Cash, wire transfer, by 10 a.m. Jake thought it was going to be like $4,000. He had the $4,000. He did not have $13,800 just sitting there. And here's the thing. This wasn't some surprise hidden fee. This was just closing costs. The thing that every single person who buys a house has to pay. The thing nobody had ever actually sat down and explained to Jake in plain English. So that's what this video is. The explanation Jake needed 6 months earlier. Closing costs are every fee, every charge, every random line item you pay on the day you officially take ownership of a home. And I want to be upfront about something before we go further. These are not small. ClosingCorp, which tracks this data across millions of transactions, puts the national average at 2 to 5% of your loan amount. On a $400,000 home, that's anywhere from $8,000 to $20,000. On top of your down payment, due in cash. Most people budget obsessively for the down payment. They save for years, and then they get blindsided by this second number they never planned for. I'm going to walk you through every major category, what it is, whether it's legitimate, and what you can actually push back on. Because some of these fees, completely worth it, and some of them are just fees. The first group of fees goes straight to your lender, the bank or mortgage company giving you the loan. The biggest one is the origination fee. This is what they charge for essentially doing their job, creating the loan, processing your paperwork, running your credit, usually somewhere between 0.5% and 1% of your loan amount. On a $400,000 mortgage, that's $2,000 to $4,000. Is it legitimate? Kind of. They are doing work. Is it negotiable? Sometimes. We'll get to that. Then there's the underwriting fee, separate from origination, which always confuses people because it feels like it should be included. Underwriting is when they evaluate your entire financial life, your income, your debts, your credit history, to decide if you're a safe bet. Usually $500 to $900, non-negotiable at most lenders. They're not moving on this one. Now, discount points. This one's optional, but it shows up on a lot of estimates and confuses buyers. 1 point equals 1% of your loan. You pay it up front to buy down your interest rate. Whether it makes sense depends entirely on how long you're staying in the house. If you're there for 30 years, yes, buying points can save you tens of thousands. If you're planning to move in 5 years, you'll never recoup what you paid up front. Run the math before you say yes to this. And then there are the fees I find a little harder to defend. Application fees. Some lenders charge $250 to $500 just to apply for a loan, before they've done anything, before you're approved, before anything. I always ask lenders up front if they charge this. A lot of them don't. If they do, that's something to factor into your comparison. This next group is called third-party fees, charges from all the outside companies involved in making this transaction happen. First, the appraisal. Before your lender gives you $400,000 for a house, they want someone to independently confirm the house is actually worth $400,000. That's an appraiser. They come out, walk through, compare it to nearby sales, write a report. Usually $300 to $700 depending on the market. You typically pay this upfront, before closing. It's not refundable if the deal falls through. Then there's title work. 2 pieces to this. First is the title search. A company digs through public records to make sure the seller actually owns the home free and clear. No unpaid liens, no legal disputes, no one else with a claim to the property. That usually runs $200 to $400. Then there's title insurance. And this one I want to explain properly because people often see it on their estimate and have no idea what they're paying for. There are 2 types. The lender's policy protects the bank, required. The owner's policy protects you, Technically optional, but I would never skip it. Together, they usually run $1,000 to $2,000. Here's why you want it. Title searches aren't perfect. Old records get lost. Errors happen. If someone shows up 3 years after you've moved in and claims they have a legal right to the property, your title insurance is what makes that problem go away without costing you everything. The one good news: in many states, it's tradition for the seller to pay the owner's policy. That's negotiable, worth asking about. Home inspection is another one. Technically, you pay it before closing, usually $300 to $500, and it's not required by most lenders. That's the dangerous part, because some buyers skip it to save $400, and then find out 6 months in that the foundation has problems that cost $40,000 to fix. Just get the inspection. Okay, so now we get to the part that really catches people off guard. Prepaids. These aren't exactly fees. You're not paying for a service. You're prepaying money you'd owe anyway. But it's still cash out of your pocket at closing, and nobody explains this clearly enough. First one, homeowner's insurance. Your lender requires you to have a full year's coverage in place before you close, and you usually have to prepay that first year at the table. Bankrate puts the national average around $1,900 per year, but honestly, it varies wildly depending on where you live. Florida, much more. Midwest, could be less. Second, prepaid mortgage interest. You pay interest from your closing date to the end of that month. So if you close on the 5th, you're covering 25 or 26 days of interest right there. If you close on the 28th, you're covering 2 days. This is actually something you can control. Closing at the end of the month reduces this cost significantly. It's a small thing, but on a $400,000 loan at 7%, 25 extra days of interest is about $1,900. Not nothing. Third, property taxes. Most lenders require you to put 2 to 3 months of property taxes into your escrow account at closing, just sitting there as a buffer. The amount depends entirely on your local tax rate, but in some areas, this adds thousands to your closing day total. I want to be clear about this. The money in escrow isn't gone. It's yours, sitting in an account, paying your future bills. But you do need to have it available on closing day. That's the part that catches people. Here's where I want you to pay attention, because this is the part most buyers don't know. Some closing costs are fixed. Some are completely negotiable. The CFPB, Consumer Financial Protection Bureau, explicitly states that you have the right to shop for certain third-party services, title companies, settlement agents, attorneys. Your lender gives you a list of approved providers, but you're not required to use them. Getting 2 title quotes alone can save you $300 to $500. Seller concessions. In a market where sellers aren't getting 40 offers on day 1, you can ask the seller to cover part of your closing costs. Depending on your loan type, that can be up to 3 to 6% of the purchase price going toward your costs. In a slower market, sellers will often say yes. All you have to do is ask. Lender credits. This is basically the opposite of buying discount points. You accept a slightly higher interest rate in exchange for the lender covering some or all of your closing costs. Useful if you need to close but you're short on cash. You'll pay more in interest over time, but sometimes that trade-off makes sense. Origination and application fees. Ask, straight up, especially if you have good credit or a large down payment. Lenders want your business. The worst they can say is no. A lot of the time, they'll move. Before you even make an offer on a house, get a loan estimate from at least 2 lenders. The CFPB requires them to give you this within 3 business days of your application, but you can ask for a preliminary estimate even before that. Don't just compare interest rates. Look at the total closing costs. 2 lenders can have the same rate and a $3,000 difference in fees. And then, 3 business days before your actual closing, you'll receive something called a closing disclosure. This is the final official list of every charge. Take an hour and compare it line by line with the loan estimate you got at the beginning. If anything changed significantly, ask why before you sign anything. Things do change, but some things shouldn't, and you have the right to question them. Before you even make an offer on a house, get a loan estimate from at least 2 lenders. The CFPB requires them to give you this within 3 business days of your application, but you can ask for a preliminary estimate even before that. Don't just compare interest rates. Look at the total closing costs. 2 lenders can have the same rate and a $3,000 difference in fees. And then, 3 business days before your actual closing, you'll receive something called a closing disclosure. This is the final official list of every charge. Take an hour and compare it line by line with the loan estimate you got at the beginning. If anything changed significantly, ask why before you sign anything. Things do change, but some things shouldn't, and you have the right to question them.